Welcome back to our discussion on the deferred tax liabilities and deferred tax assets and their effect on the financial statements. In the previous session, we have seen that with a given transaction, how there is deferred tax liability, and the deferred tax liability was there because there is a deferred tax, and the deferred tax is there because of the timing difference. The profit as per the income statement is not same as the profit as the tax statement because of the dividend and because of depreciation. But the depreciation difference is treated as a temporary or a timing difference, where the dividend difference is considered to be a permanent difference. So let us see in the second year what happens with the same information given for the same company. So we are selling the goods. So the opening cash in hand is 354. The balance stock is sold for 250. The balance stock is sold for 250. And so the sales is also in the form of cash. And whenever there is a sales, there has to be inventory, and inventory cost will become an expense, and as a result the stock will become zero. The operating expense for the period is once again 10,000, and let us assume that we paid that 10,000 during the period. The depreciation for the period is once again 25% straight line, so the value of the plant will come down to the extent of the depreciation for the year. The interest for the period has to be paid 0.08, and let us assume that we pay the interest for the period. No purchase of the plant during the year. So, and also we have received during the period the dividend 20,000, and dividend is also a cash inflow and an income. So the total income for the period is 270,000. Total expenses for the period 60,500. So profit before tax is 209,500. But to calculate the tax, we have to go back to the tax statement. So in the tax statement, we can see the sales is taxable, dividend is not. The COGS, cost of goods sold, is same as income statement. Operating expense same as accounting, but depreciation is not same as the accounting because you have already claimed 100% depreciation in the previous year. Interest same as accounting. So the summation of expenses is 48,000. Tax profit is 202,000. Assuming tax rate to be 30%, the tax payable is 60,600, and that is called as a current tax. And we can find the deferred tax, and deferred tax in this case will be negative 3,750. Negative 3,750 because we can see that there is no depreciation in the taxation, there is depreciation in the income statement. So this is considered as a deferred tax. So the tax, after the tax, the profit after tax will be 152,600. If no information is given, we transfer the entire profit to the reserves. And deferred tax liability, the liability will change to the extent of the deferred tax of the current year, which is negative deferred tax. No other changes. We can now find the cash in hand, and let us assume that we paid the last year's tax plus the current year tax, which is 91,200. So as a result, the tax payable will be 30,600 plus the current tax minus the tax payable, tax paid, so it is 0. The entire tax is assumed to be paid in the current year. So the total cash in hand can be determined now. The cash in hand is equal to cash available minus cash payment, and cash available is 624,000. So cash in hand will be an asset which is 516,800. No change in the capital in the current year, no change in the loans in the current year, no change in the debtors in the current year. The total of the sources side is 1,016.8. No change in the shares, no change in the debtors, no change in the R&D. We've been consistently assuming that R&D is not amortized and also not impaired. So the value of the assets is equal to the value of the sources. But the focus was on the deferred tax, and the deferred tax in this case is a negative deferred tax. So this negative deferred tax can also be shown in the balance sheet as a deferred tax asset. We can show the deferred tax, instead of showing deferred tax liability reduction, we can show the deferred tax asset as 3,750 on the asset side. Whereas here we have shown the deferred tax as a negative deferred tax adjusted to the deferred tax liability. That's a presentation. If it is adjusted to the DTL, it is called adjusted or net DTL. Otherwise, some companies may also show as a DTL and DTA as two separate items. So therefore, in the balance sheet and in the income statement, deferred tax arise because of the temporary differences. And the temporary differences, one of the common items on the temporary differences is the depreciation. Thank you very much.